Hey everyone, Mr. Terrell here with your e-learning lesson for April the 17th. On Wednesday, we started talking about the different type of business structures that exist, and the first one that we covered was a sole proprietorship. And we said that a sole proprietorship was the most simple, basic type of setup that there was, that basically there was one owner, and that one owner not only had all of the control for that business, but they also held all of the liability. And so it was the most simple business structure that existed. Today, we're going to get into our second type of business structure, and that is a partnership. And partnerships are very common in agribusiness, particularly for farms and ranches. You'll see many farms that are owned by partnerships, usually within the same family. Maybe a brother or a brother and sister that farm together, maybe a father son or a father daughter that farm together. Things of that nature. So partnerships are very very prevalent in agribusiness. So our objectives, we're going to define and examine the distinguishing characteristics of a partnership. We're going to talk about the special types of partnerships. We're going to identify the components of a partnership agreement. And then we're going to compare and contrast the advantages, disadvantages, and considerations when developing a partnership. So how does a partnership work? Okay, a partnership is a form of business where two or more people go into business together. So you know, traditionally you would think of a partnership as a pair, two people, but it could be three, four, five. There's no limit to the number of partners that you could have. Basically, the partners pool their money to start the business. So if you have a situation where, capital is an issue and getting enough startup capital to start your business, a partnership is sometimes a good way to go about it because you can pool your resources. Maybe one person doesn't have the resources needed to start the company, but if two or three go together, they can get the resources that they need. Now, what's important with any partnership is that we need a written agreement that specifies the terms of the partnership. That spells it all out on paper. That way, everyone's clear. It explains what the responsibilities of each partner are and what percentage of the business each owns. Each partner doesn't necessarily own the same percentage of the business. The percentage that they own is going to be based on what they invest. So if there's one partner that puts in more startup money, obviously that partner is entitled to a larger share of the business. There are such things as a silent partner, just a person that invests money that doesn't really involve themselves in the day-to-day operation. They just simply are entitled to a share of the profit. Those types of partners exist as well. But it's important that we get that down on paper. That way everyone's clear what the agreement is, how much of the company each partner owns and is entitled to, and then what each of the partners is responsible for. So profits and losses are divided as agreed. So it's going to be based on how much you own. The larger percentage that you own, the more profit you're going to be entitled to, but also the more loss that you're exposed to. Okay, you could potentially experience a larger loss. The partnership may own property. In the case of an agribusiness, you're probably going to own some property. You may rent some ground, but you're probably going to own a certain percentage of your ground as well. Partners also share liability. So, like we said, partners share profit, but profit isn't always a guarantee. And there's a potential that uh, you could find yourself taking a loss, and partners have to share in that. So, they share responsibility for debts or for wrongful acts. So each partner is responsible for the partnership's liabilities. Okay, so if you take out an operating loan for your business, um, everybody in the partnership is liable for repaying that loan, and each partner is liable for the other partner's wrongful acts as a partner. So you have to be very careful who you go into a partnership with. It needs to be someone that you trust very, very uh, deeply, because if your partner decides to go in and commit fraud and do something illegal, not pay their taxes or something like that, you as their partner in business could be held liable, okay, for that. So you need to be very, very careful who you go into a partnership with. Records are necessary, and that's the case with any business, particularly though with a partnership. That way, uh, we're keeping track of all things in terms of profits. We're keeping track of tax information, who needs to file taxes or who needs to pay what in taxes. Um, it's really best for everybody involved in a partnership to file an individual tax return. So you're not going to be able to file a tax or file taxes as a partnership. Each of the individual partners really needs to file and pay those taxes individually. Typically, a partnership is dissolved upon the death of a partner, and that's one thing that makes it a little tricky. Is you have to be careful, I guess, in terms of how you structure things, because if you don't have some sort of a contingency plan, if one of the partners does die, you could find yourself in a bad spot because your partnership would be dissolved, and it can be tricky to navigate that after the fact. So there's some special types of partnerships that exist, limited partnerships and limited liability companies. And we'll talk more about um, those in a little bit. A limited partnership is a work relationship with an individual who provides capital but has no decision-making powers. The person is only liable for the amount invested. So we've already talked a little bit about a silent partner. So an example of a silent partner would be, let's say there's a seed treatment business in my community, and I realize the business is successful. I see the potential for profit there. I approach the individual that owns the company and says, "Hey, I would like to become a partner in your company. I think we could expand this business. I think we could purchase some new equipment. We could expand our facilities. I want to purchase 25% of your company for X amount of dollars, but I don't want to do anything with it. I don't have any time to devote to the company in terms of the day-to-day operation. I just want you to run the company. I just want to be a silent partner at 25%. That means that I own 25% of the company, but I don't actually do anything in terms of day-to-day management of the company. I'm just entitled to 25% of the profits." That would be an example of a silent partner. An LLC is a legal form of business offering set losses to the owners to the point of their capital contribution or the personal money invested. So an LLC basically provides protection from unlimited loss. It basically allows you to only lose the amount that you put in. So you can't lose any more than you invested in the company through an LLC. All LLCs will have at least one member. LLC members are the owners of the LLC as well. So LLCs, and we'll get into LLCs in more detail later on, but basically LLCs are very highly regulated by the government. It's a government program set up to protect business owners and protect investors, and the idea is you can't lose any more than you invest, and that's very appealing to many business owners because it does reduce their risk quite a bit. So a member's ownership in just one LLC, okay, is called their stake. Okay, membership interests are uh, often divided into standardized units, which in return are often called shares. Units to equally divide portions of the business for control of decision making. So basically, an LLC is a watered down version of a corporation. So the person with the largest member proportion is referred to as the manager. And the manager runs the day-to-day operations of the LLC. So they will take that company, they'll divide it up into shares, and a member's ownership in just one LLC is called their membership interest. Their membership interest. So LLCs must file their existence with the Secretary of State in the state where the business is organized. You have to register your name and you have to clearly state your business purchase. So compared to a sole proprietorship, an LLC is going to have a much bigger government paper trail behind it. You have to be very, very clear and upfront with the government and register your company name and be very clear about what your company does. That's kind of the trade-off with an LLC. You get that protection, but you do or you are subject to a lot more government regulation. LLCs will be assessed fees by the state, and membership interests may be regulated by state and federal governments. So compared to a sole proprietorship, a lot more control. And, an agreement must be developed, usually by an attorney. This agreement is a document that determines, defines, and sets the rights of the partners. It also just distributes income received from the partnership. So you have to have that agreement in place so that everyone's clear what the arrangement is. LLCs are taxed the same as regular partnerships, no different. The difference is you'll have to pay those extra legal fees assessed by the government. So the advantages, obviously, you're protected from the acts of other partners or the debts of other partners. You get that protection that you don't get with a normal partnerships. With a normal partnership, an LLC prevents double taxation as well. The disadvantages, though, there's difficulty in raising capital because investors are unable to recover the personal assets of the partners. So banks are very unlikely to want to lend money to an LLC because the bank knows that the assets of the people borrowing the money are protected by the government. So if they loan you the money and you default on that loan and you don't pay it, they can't come after everything that you own like they could with a sole proprietorship. With the sole proprietorship, they can come and seize your assets. With an LLC, um, they're not going to want to be able to do that. So that's going to create some apprehension from lending institutions to give you money. And then some states levy a tax for LLCs. So let's talk about the components of a partnership agreement. So the partnership agreement, like I said, it contains 5 articles, usually drawn up by an attorney, and it states explicitly what the arrangement of the partnership is. So Article 1 states the nature of the partnership, the business name, the duration of the partnership, and then what states the business will operate in. And it establishes where the business will be conducted at. Article 2 contains the details about financial matters, specifically stating capital contributions of partners, in addition to details about loans that are out there, debt that the company has accrued, um, and then your profit and loss statements. Article 3 puts out the rights and duties of the partners, so what everybody in the partnership is responsible for. Article 4 states membership changes, so how to add partners or how partners can leave or transfer ownership. This is really important when it comes to potentially dissolving the partnership long term. You need to have a contingency plan in terms of what if a partner wants to leave or what if a partner wants to pass their ownership stake onto their son or daughter, that type of thing. And then Article 5 is just anything miscellaneous that wants to be established by the partners, and that kind of varies from partnership to partnership. So all the partners have to sign it, and they have to be consulted if any partnership changes are made. If a partner is added or a partner leaves or the stake of any one partner is changed, all the other partners have to agree. So real quickly here, the advantages of a partnership. Uh, it allows you to pool your capital, it allows you to pool your knowledge, and it allows you to divide up the labor and management among several people. You're also sharing your risk. The disadvantages, you have to uh, agree with other people. You can't make decisions on your own and do things quickly. You have to make sure they're approved by others. Death or illness can be an issue. It can dissolve the partnership if someone dies. There's unlimited liability among the partners, and each partner is personally liable for business debts. So some things to consider real quick. You have to have understanding and tolerance when you're dealing with a partner. Partners often have different goals, and you got to deal with that. Um, and you have to be ready to disagree with your partners on things. It's just part of it. Okay, we'll go ahead and stop here. There is an assignment that I want you to complete. Uh, Let me know.